All right, here we are. So first, let me get the notes open. We're starting something new tonight. So let me go over to Brightspace and open up our notes.
One of my class. You on the flip phone? No. I didn't think everyone would go into the fucking view. I told everybody just, you know what I told everybody? I was like, yo, put yes, and people would go. And I was lit. Yo. Yeah.
Okay, sorry, it's 4. Okay, so this is chapter 4. And if we have time, we may start looking at chapter 5 as well. Chapter 4 is our discussion about exchange rate determination, where they develop a theoretical framework for explaining what exactly is it that determines exchange rates in the marketplace. And so it's actually done in terms of supply and demand from economics, which is kind of interesting. And then chapter 5, which maybe we'll have time to look at it, is an overview of currency derivatives, which we briefly discussed last week or the week before. But it's a much more detailed look at what types of products are out there and how they can be used for hedging purposes. So it's a very intense area. You could take an entire course in just derivative securities. Here, our interest in credit derivatives is how are they used to hedge exchange rate risk, but also, of course, we also want to keep in mind that people may want to use them for speculative purposes as well, so that in other words, they're basically gambling on the future direction of exchange rates. So we have both in the marketplace at any given time. All right, so we'll start here. Let me open this up. Now, there's a lot of theoretical models of exchange rate determination, but this is a fairly standard approach to think in terms of the supply and demand of currencies. And so, in other words, in that sense, it's very similar to what we've seen in basic micro, where we can think of the exchange rates, which are prices of currencies, as a type of asset. So, in other words, dollars, pounds, euros, etc., are in principle nothing but financial assets, just like stocks and bonds. And so their price will be determined by supply and demand. But the interesting part is what factors actually affect the supply and demand for a currency. It's not exactly the same as it is with other markets, because central banks are a major player in the foreign exchange market. And you don't get that with, let's say, the stock market or bond market. So we always have to take into account the actions of the central bank when we try to determine the behavior of exchange rates. So I don't think there's any exciting news in the foreign exchange markets this week. Let me just take a quick look at Bloomberg for a second, just in case something happened. There's a lot of exciting news, but not necessarily in the currency markets. The currency markets, sometimes they can be very stable, sometimes they can be very volatile. A lot of it does depend on what's happening in, the economy, of course, but it's also, they tend to be very sensitive to political turmoil. So right now we have a lot of political turmoil. And so it's very possible that the exchange rates are fluctuating as a result. Like for example, the Chinese currency, the yen, extends loss with China proxies as U.S. trade war reignites. Okay, so yes, we know that there's a lot of talk about tariffs between the United States and our major trading partners. And now, of course, that's going to make their products more expensive in the United States, which means that it will reduce their trade surpluses, and it will help, presumably, our trade deficit at least shrink a little bit. So, this is a very interesting time, because you don't normally see a government start to suddenly impose large tariffs in other countries. So we're getting to some kind of unknown territory here. And so it will be very interesting to see what happens to stocks and bonds and currencies as a result of all this. Um, Now, if we go to CNBC.com, they usually have a lot of updated articles about what's happening in the markets. So it looks like the Dow may have slumped a little bit. Now, by the way, I do want to mention an interesting feature of this CNBC website. What happens is during the day when stocks are trading, at least in the Western Hemisphere, you'll see these quotes all day long: the Dow Jones Industrial Average, the Standard and Poor's 500, the NASDAQ, et cetera, et cetera. Now, once trading closes, though, what's going to happen is after hours, stock index futures continue to trade in other markets, for example, in London and in Tokyo. And so what you're seeing here is the prices of those futures contracts that are trading in those other markets. And they're often used to give us a sense of what kind of sentiment there is in the market. So you can see they're all down right now, which means that tomorrow, when the markets reopen in the United States, there's a very real chance that all of these indexes will fall, because what you're seeing here is selling pressure. A lot of traders are thinking maybe we should sell some of these stocks before they start falling. And so this is often used as a forecast of what to expect tomorrow. So that red is referring to futures contracts, but still it means that market sentiment right now is somewhat negative. And so you can see these numbers are negative. They're not hugely negative. Like, sometimes the Dow goes down 3, 4, 500 points in a single day. Negative 36 is not that negative. In fact, by the time we're done with this class, it might have turned back into positive territory. Same thing over here. The S&P 517 is not that much of a loss. The NASDAQ, well, it's still suffering a little bit, I think, from earlier in the week when China announced, or that Chinese company announced, some new breakthrough with artificial intelligence. And of course, since most of the high tech stocks trade on the NASDAQ, it stands to reason that the NASDAQ would be affected the most. So as far as the currencies go, if you come up here, they have a little bit of everything up here. Let's see if we can find the currencies page. Oh, here we go. Here we go. So yeah, it looks like, they have prices, of course. I don't see any actual articles here. Oh, no wonder. I guess they want you to subscribe to this system, Currency Pro or whatever they called it. And then you can get the articles as well. So, you can usually find this on the internet for free. All you have to do is Google dollar or the dollar. Here we go. Oh, so that's Nigeria. I don't know much about Nigeria. Let's go find another one. Here's the Wall Street Journal. Okay, now I actually have a subscription to the online Wall Street Journal. That's why I'm able to see these articles. If you went to the same page, you might not be able to see all of this. So the dollar index, which is basically, it's a construction of, it's essentially the price of a basket of currencies that represent our major trading partners. Oh, no. Oh, no. I guess they don't recognize me. Oh, no, I didn't know that. Oops. Wow. Okay, sorry, everyone. I didn't realize my subscription expired. So, all right, well, that's the end of that. Okay, well, anyway, let's just get back to our notes. So again, what we're looking at is the determinants of exchange rates. So we start out by noting that we want to understand, first of all, how do we measure exchange rate movements? And then taken from economics, we want to understand how the the equilibrium exchange rate is determined. Now, remember, if you remember from basic micro, the equilibrium exchange rate is the rate at which there's a balance between supply and demand, which means there's no tendency for the price to change once we reach that level. We want to know what factors determine this equilibrium exchange rate. We also want to kind of understand how cross exchange rates change over time and how financial institutions try to profit from changes in exchange rates. In other words, how do they decide which currencies to hold, which ones to sell, and what type of hedging strategies they might decide to undertake. Okay, so we'll start by noting that the two basic ways in which an exchange rate can change is by either depreciation or appreciation. So let me show you a numerical example of this real fast. Okay, so let's say that we look in the Wall Street Journal and the exchange rate between the dollar and the pound is $1.20. Okay, that's about right. So let's say today is February 4th. So here's our exchange rate on February 4th. And the next day we wake up and we see that the exchange rate has gone to, let's say, $1.30 a pound. Now, whenever an exchange rate like this changes, it means one of the currencies has gotten stronger and one of them has gotten weaker. So the way to think about it is this. Since it now takes more dollars to buy a British pound, this means that the dollar has weakened, which means depreciated. And the pound, of course, must have done the opposite. It has strengthened. Which is the same thing as saying appreciated. Okay. So when exchange rates change like this, it always means one currency got stronger and the other got weaker. The question is which is which. Now, of course, this might be reversed the very next day. If the currency of a country that's struggling financially or their economy's slumping, let's say, might go through an extended period of depreciating. Sometimes this is just normal fluctuation in the market. Exchange rates are pretty volatile. They might bounce up and down for no particular reason. But if there's a long-term trend and a country's economy is in a recession, for example, the currency might experience a long, prolonged decline. Or on the other hand, if the country is doing very well, their economy is booming, they might experience a very long strengthening or appreciation. And I think I showed everyone last time where to find information, at least about the dollar pound exchange rate over time. If you go to the Federal Reserve Economic Database, FRED, you'll find what you need. Okay. This is Exchange Rate Guru. I don't know them, but let's see what they have. Oh, I see. What they're offering to do is see what they've done here is they've given us an exchange rate quote. It's dollars. This is actually pounds per dollar. Okay, that's kind of awkward to deal with. So let's change it to pounds per dollar. Now, by the way, if you notice, it looks backwards. Notice how pounds are here and dollars are here. But yet, in spite of that, this actually means $1.25 per pound. So that's why I've written it like this. I find this to be much clearer when you write it like this. But in practice, you might find that when you look at exchange rate quotes, let's say in the Wall Street Journal, it might be written like this. I don't know why they have to do it like this, but I find it easier to write it like this. So this tells me that the dollar price of the pound is $1.25, and here it's $1.30. So yeah, they don't seem to have too many currencies here, but it's yeah. Well, they do have a Bitcoin in here. Looks like it's not quite at $100,000 yet, but it's getting close, isn't it? And you can see over just the last month or so, this is how much change we've seen in the dollar pound exchange rate. Um, so it can bounce around quite a bit over time. Anyway, let's get back to Fred. Actually, all right, I'll have to ask for it again. Fred, dollar pound exchange rate. All right, here we go. So here it is. Fred is actually the Federal Reserve Economic Database. It is housed at the Federal Reserve Bank of St. Louis. And so let's say that we're interested in let's look at daily rates, I guess. Okay, so this one's going back about 5 years or so. And during this period, at the moment, it's hovering around $1.23. It's been as low as $1.13 and as high as $1.40. And that's only within the last few years. So you can see it can move around quite a bit. If we go back even further, well, there you go. You can see that about this is actually just before Brexit. That was more normal in the past, around $1.55 or so. And there's been times when, ooh, look at this, 113. Now, if you go to Max, now Max is going to show us, it only actually goes back to the 70s. You can see there have been times when the pound was insanely expensive. Look at this, it was up around 260, but then down here in the 80s, it was just barely over $1. There was a time when it took just barely, almost exactly $1 to buy a pound. And that's not normal by historical standards. So that was a time, by the way, when the U.S. economy was absolutely booming. I don't know if the British economy was in trouble, but the U.S. economy was insanely strong at that time, and that probably is the reason why this is happening. Now, later on, when we start looking at the history of exchange rates, we'll see that there was a time in the early 20th century when it took almost $5 to buy a single British pound. Okay, but circumstances were very different in those days. For one thing, we were on the gold standard, and for another thing, World War I kind of blew that out of the water. The British economy was still kind of the leading economy until right around World War I, after which the United States basically became the world's leading economy. So anyway, so what they want you to see is that when there's a change in the exchange rate, we can calculate it in two ways. The absolute change is just the difference between the two, which you would expect. Which you can clearly see is 5 cents per pound. But sometimes we see it calculated as a percentage. And in that case, what you have to do is take this absolute change and divide it by the original exchange rate. And so you're calculating it as a percentage now instead of an absolute amount. And so that's going to, let me get out my calculator here. 5 cents out of $1.25 is going to be about 4%. Okay, so either way, we can see that the dollar has gotten weaker and the pound has gotten stronger by 5 cents per pound or 4%. Okay. Now here, this is another example they've made up. They want you to see how it changes, but I think our example is just fine. One thing they did differently than us, though, is that what they also added at the end here is they went through a bunch of monthly data and they calculated percentage changes, and then they calculated the standard deviation of the monthly changes. So that number is an indication of how volatile the exchange rate is. Okay, so for example, the changes in the US Canadian dollar exchange rate had a standard deviation of about 1.04%, whereas the dollar versus the euro is about 2.31%. So that just simply means that that exchange rate pair, dollars per euro, is much more volatile than this one. Okay, so in other words, if you can imagine drawing a graph for the two, in fact, we might as well do that right now. How about see if Fred has dollars per pound? Wait a minute. No, of course it has dollars per pound. How about dollars per euro? Okay, now it's being stubborn. Yeah, it does seem to be bouncing around quite a bit. Although it's hard to tell from a graph. You have to really have the numbers, the standard deviations. And then they also mentioned the dollar Canadian dollar exchange rate. That one's pretty volatile too, but you notice, but if you look at those standard deviations, according to what we saw there, this indicates that the dollar Canadian dollar exchange rate should be more stable than the dollar euro exchange rate. Now, part of the reason for that is because the US and Canada trade so much with each other. Their business cycles are likely to be more closely aligned with each other than the business cycle between the United States and the European countries that use the euro as their currency. So that would make perfect sense that our economy is more tightly aligned with Canada. So the dollar Canadian dollar exchange rate would be not so volatile as it would be between the dollar and the euro. Not to mention the fact that the euro actually consists of 20 different countries whose economies could be performing very differently at any given time. So that would be another reason why this exchange rate is fairly volatile compared to this one. All right, now equilibrium exchange rate. This is what they're building up to. So what they're going to do is develop this framework for us. And this is for the dollar pound exchange rate. And so you might recall from previous classes that with the supply and demand framework, we have on the vertical axis, price of a good, and on the horizontal axis, we have the quantity of the good. So our supply curve is upward sloping because when the price rises, the product is more profitable to produce. And so producers are willing to produce more of that good. So in other words, in order to produce more units, the producers expect a higher price. On the other hand, from the consumer's perspective, the lower the price of the good, the more they're going to buy. Of course, that's why things go on sale, because they know that more people will buy a product if it's on sale. So the demand curve is downward sloping, where they cross. This point is referred to as equilibrium. And this, this is where the quantity supplied of the good equals the quantity demanded. And we have the equilibrium price, the equilibrium quantity. So this is the only price where there's no tendency for the price to change. It's very stable here until or unless something comes along to impact the supplier demand of this good. The price may stay here for a significant length of time, but if some factor comes along and does shift one of the curves, then we'll have a new equilibrium price and quantity. Okay, so let me show you a couple of examples of that. So let's say that for whatever reason, supply of the good goes up. So the one is there to indicate that this is the original value, and then the supply, let's say, goes to the right. So whatever this good is, the supply just went up. So you can see from this graph that when the supply of a good rises, the equilibrium price falls, and the equilibrium quantity rises. Okay. Now, if the supply falls, then this would all work in reverse. Okay. Then the equilibrium price rises and the equilibrium quantity falls. So because the curve is shifting to the left, let me show you that one. Okay, so here's the original quantity, here's the new quantity, new price, sorry, old price, new price. The price did go up, the quantity oops, went down. All right, what about the demand for the good? What happens when the demand changes? All right, good question. So we'll start with a change in the demand. Let's say the demand goes up. People want more of this product than they did before. So what this is telling us is that if you notice, equilibrium, the equilibrium price rises, and so does the equilibrium. So in other words, what this is basically saying is that if people want more of this product, they can have it if they're willing to pay for it. All right. So you want more, you have to expect to pay a higher price for it. Like it wasn't that long ago, it seems like, that all of a sudden organic produce became all the rage. In other words, you go to the store and you see regular onions, and then you see organic onions. And of course, the organic onions are more expensive. And in the past, people probably would not be willing to pay the higher price, but all of a sudden, it became all the rage to only use organic goods. So the price of the organic onions would have gone up, but also more of them would have become available. So when the public suddenly decides that they want a product more than they did in the past, this is what normally happens. And then, of course, if the demand falls, it's the reverse happens. The equilibrium price falls, and so does the equilibrium quantity. So, certain types of products, people realize that it's very unhealthy, for example, and they want to buy less of it. Like maybe people get on a health kick and their demand for fast foods goes down. So this could represent the demand for fast food hamburgers, let's say, and people decide, maybe we should eat healthier. Let's have something different. And so they buy less hamburgers. The price drops and the quantity drops too. So this is true for any good in any market. Now, what they're suggesting here is that in this framework, the pound is being treated as another type of good, and its price, in other words, the exchange rate, is determined by the interaction between supply and demand. For the pound. Okay. And so, although we think of the pound, it's not so much, it is kind of a good, but it's really more of an asset because the way to think about this is that the supply of pounds comes from the UK. Okay. That's an important detail. We as Americans can't produce our own pounds. They have to come from the UK. The demand for pounds, though, mainly comes from two sources. The demand for British goods and services, and the demand for British financial assets. All right, so really the two main things that you might do with British pounds as an American are buy British goods and services, in other words, imports, or invest in British financial assets like British stocks and bonds, or maybe keep your money in a British bank account. So the demand is, and the supply and demand are a little bit different than for a normal product. Like, this is very different than the supply and demand for onions, let's say, because American farmers can make more onions if they have to. But the supply of pounds is coming directly from the UK. So that anyway, so we're setting up this framework where on the vertical axis, you notice how it has the value of the pound. Now, when they say the value, they mean the dollar price. I get that's kind of awkward in my opinion. I think what we should probably do is just write it as dollars per pound. And on the horizontal axis, it would be the quantity of pounds either supplied by Britain or demanded by the United States. So think of this as the price of the pound. And this would be the quantity of pounds. Great. Now, once we have this established, we can establish or define a supply and a demand curve. So you can see they've got the three exchange rates, and at these three exchange rates, we have three different demands. So let's see, they've got 160, 155, and 150. Now, here's the interesting part. Let's call, I guess we can label this points 1, 2, and 3, just to make it clear what we're talking about. At point 1, the dollar is relatively weak. So Americans, the demand by Americans for British pounds is relatively low. Okay. But if you notice, as we move down that curve, as we move down the curve, band curve that is, from 1 to 3, the dollar is getting stronger. And so Americans will buy progressively more British pounds. Okay. So in other words, as the dollar gets stronger, we can buy them at a cheaper price. And of course, that means we'll want to do exactly that. It's almost like when you're going down in this direction, it's like the pound is going on sale. We want to buy more of them because they're cheaper for that very simple reason. Okay, now let's consider the supply curve. So now from their perspective, um, Americans can obtain pounds from the UK by selling either American goods and services or financial assets to the British, who pay for them with pounds. In other words, if we sell goods and services to the British, they're going to pay for it with pounds. So that's how we get our hands on pounds, by either selling them goods or services, or else um, selling them investment assets like stocks and bonds. So that means that as we move from point one, where the pound is relatively weak, to point three, where the pound is relatively strong, the British are willing to buy progressively more American goods and services and financial assets. So supply of pounds increases. And that's the reason why the supply curve is facing upward. Okay. So as we go to the right, we have a progressively stronger pound, and we also have a higher supply of pounds to the United States. And then, of course, at some point, we bring them together. Okay, so let's do that. By the way, the quantity on the horizontal axis is the pound. Okay. It's the quantity of pounds that is being determined in this market, or in this framework. So we have S Okay, so what I wanted you to see here is that they cross. I'll tell you, let's label these 1, 2, 3, 4, and 5. All right, so it's at point three where we have our equilibrium, because that's the only place where the quantity supplied equals the quantity demanded. This is the equilibrium exchange rate. In other words, $1.55 per pound. What's going on at the other two with the other two cases? So at $1.60 per pound, we do not have equilibrium, because as you can see from the graph, the quantity supplied, pounds, exceeds the quantity demanded. All right, so you can see by looking at the graph, you see at $1.60, the quantity supplied is 0.5, the quantity demanded is 0.4. And you can see that this is greater than, actually, let me do this. Let me put in some actual numbers here for a second. Instead of calling it 5 and 4, here, let's say at this point, the quantity is, I don't know, let's say 1,000. So up here, the quantity supplied is 2,000. Quantity demanded, though, is only 1,000. So this is referred to as a surplus. In other words, more pounds are being made available to the United States than Americans are willing to buy. But down below here, we have the reverse situation. The quantity supplied is only 1,000 at 0.1. Quantity demanded is 2,000 at 0.2. So this now, the shoe's on the other foot. People in the United States want to buy a lot more pounds than the British are willing to supply to us. So this is referred to as a shortage. Now, when there's a surplus or a shortage, the markets will adjust. Okay, so I started to write that down here at $1.50 per pound. The quantity demanded of pounds exceeds the quantity supplied. Now, the markets will adjust very quickly to this. So in the top case, when there's a surplus, and this is true for any good, the quantity supplied will shrink and the quantity demanded will grow. In fact, let's see what I can do. So when there's surplus, you'll have a movement down towards the equilibrium because oh, I don't know what happened here. Just want to make sure I didn't goof something up here. All right, that's fine. Okay. So anyway, as I started to say, when there's a surplus, the quantity supplied falls and the quantity demanded rises until the market reaches equilibrium. Okay, and this happens automatically. I mean, the market participants are well aware of this situation. They know that there's too many pounds floating around, and the investors are simply not willing to hold so many British pounds, and then so when the prices start to adjust, the British will supply fewer pounds, but the Americans will buy more pounds, and so at some point the two will meet up at 0.3. Whereas if we're at the bottom, down here at points 1 and 2, meaning that there's a shortage, everything works in reverse. So here the quantity supplied rises and the quantity demanded falls until the market reaches equilibrium. So that it would look something like this. The supply rises, demand falls, and here you go. We're right back at 3. So most normal markets, unless the government interferes somehow, which does happen sometimes, in free markets, prices adjust automatically until equilibrium is reestablished. And it can happen very quickly. Especially a market like this where $7 trillion worth of currencies are trading every single day. This won't equal being out of equilibrium won't last very long. Okay, now what's going to happen here to interrupt this is that so far we haven't really seen, at least not with the British pound, what would happen if supplier demand changes. So what we would like to do is consider what kinds of factors would actually cause the supplier demand curves to shift. So if the supplier demand curves shift, a new equilibrium point will be established and prices will adjust until the market is once again in equilibrium. Okay, but what we want to consider here is what factors could actually cause this to happen. So that's where we're going next. So yeah, this is pretty much what we've already talked about. So what we want to look at is, yeah, here we go. This is what we want now. What factors are going to cause this to happen? So they're telling us that these are the main factors that can cause changes in supply and demand. So, by the way, just want to note here, this little triangle is the Greek letter delta, and that is used to represent change. So, for example, the change in the inflation differential between the two countries. Okay, so all right, so we start with inflation. Now, specifically, the difference in inflation, which is what really matters between two countries. Okay, so in other words, for example, suppose that US inflation is 3, and UK inflation is 5%. So this means that purchasing power is falling more quickly. In the UK than in the US. This means, or this reduces the attractiveness of UK goods and services and financial assets relative to those in the US. Okay. That this will tend to weaken the pound and strengthen the dollar. Okay, so in other words, think about it this way. As a result of this inflation differential, demand for British pounds in the US will decline, and the supply of British pounds to the US will rise. Why is that? This is because Americans buy fewer British goods, and the British buy more American goods because they're cheaper or they're becoming cheaper. So that means two things are happening at once. So this is a fairly complicated case. Um, all right, so in other words, more British pounds and are being bought or sorry, supplied to the US by the British, but the Americans are buying fewer pounds. So let's say we're down here somewhere. Okay, so in other words, you can see that by the price going down at a lower exchange rate, the dollar is stronger and the pound is weaker. Okay. Now, this is not based on the absolute levels of inflation. It's only the differential that investors are responding to. So like here's 3 and 5. If it had been like 8 and 10, it doesn't really matter because it's still a 2% inflation differential. Okay. So the net effect here is this, is that countries with higher inflation rates will tend to have weaker currencies. Okay. So that's, in other words, inflation is detrimental to a currency. Well, all right then. How about, so what's the next factor? Oh, before I forget, I better save this thing. I'll be very upset if we lose the power or something. I'll just call this extra. All right, there we go. Very good. Now, what else do we have here? Interest rates. All right. Now, what does that have to do with anything? All right. Many investors see currencies as a type of investment or a type of financial asset um, by holding, if an investor holds, let's say, British pounds, or let's think of this as an American investor. Then he or she can use them to earn the British rate of interest in a UK bank account. So imagine yourself looking around and seeing that the US is paying 3%, let's say, in its bank accounts, and the UK is paying 5%. You may be tempted to trade some of your dollars for pounds and invest them in the UK. Now, by the way, this does expose the investor to foreign exchange risk, of course. But investors may um, feel that the higher interest rate in the UK justifies the extra risk. By the way, why don't we look at a quick example of this? Suppose that the exchange rate between the dollar and the pound, let's go back to our original example of $1.25. Okay. Fine. An American investor converts $1,250 to 1,000 pounds. All right, so by dividing the number of dollars by the exchange rate, I end up with the number of pounds. Now, this is invested for 1 year at a rate of, let's say, 5%. In 1 year, the balance in this account will be, so here, what you're going to do is multiply the 1,000 pounds times 1.05. In other words, 1 plus the rate of interest in the UK, which is 10.50. Now there's no question about that. That's beyond dispute. Now here's the problem though. How many dollars will this deposit be worth here? That depends on the exchange rate in 1 year. So let me show you two examples. In case one, in 1 year, the exchange rate is, say, $1.40 per pound. The dollar got really weak. And let's say in case two, in 1 year, the exchange rate is $1.10, let's say. The dollar got really strong. So how do we figure out how many dollars we have here? Well, what we're going to do is take the number of pounds and multiply. So in other words, to go back from pounds to dollars, we're going to multiply. And let's see what that turns into. All right, I need my calculator for this. Uh, 109. Wow, that sounds like a lot. Yeah, $109,200. No, that can't be right. Hold on a second. No, no, yeah, no, I did something wrong here. Hold on. I think it's 1,092. I don't know what I did in my calculator. Hold on. Yeah, no. Well, I don't know what was showing up in my calculator. I've got 1470 this time. All right, let me just double check that. Oh God, what is this thing doing? 1050 times 1.4. God damn it. I know what it is. I didn't type it right. I'm using this cell phone thing, which if you don't hit the buttons hard enough, yeah, it's 1470. Great. This means that the investor earned a rate of return of, and so it's 1470 minus 1,000 divided by 1,000, that's a pretty hefty rate of return. Sounds awfully high, doesn't it? No, but that's it. Hold on, let me just double check something. Oh, no, no, no. I know why. Because I forgot. I started with not $1,000, but 1,250. No wonder it sounded so high. I knew something was wrong. It should be closer to like 17%. So you made $220 on an investment of 1,250. That's what happened. That is, yeah, 17.6%, right? That sounds a lot more like it. Now that's not too shabby. Given that the British rate of interest was only 5%, somehow you managed to make 17.6%. So in other words, the remaining 12.6% actually came from the gains when the dollar got weaker. Okay. The dollar lost about 12.5% against the pound. But now in this case, let's say it's 110. So when you do the same calculations, instead of multiplying by 140, it's 110, and that's going to bring it all the way down to 1155. So you know what? In this case, you actually lost money. Look at that. Wow, that hurts. So even though you made a 5% rate of return from your British bank account, it doesn't matter because you got wiped out by the change in the exchange rate. And so you end up with a loss of 0.076. In other words, you actually have 7.6% less dollars than you have now. I had before, I mean. Wow. So you can see you got to be careful when you invest in foreign financial assets or foreign anything for that matter. So as long as the exchange rates remain stable between the two countries, though, investors may decide to invest in the foreign country when their rates go up. Just because, they're like, well, I only would have gotten 3% in the United States. That's true, but at least that's guaranteed. So, but in general, when interest rates go up in a foreign country, that tends to strengthen the foreign currency and weaken the dollar. Okay, so in general, if UK rates rise relative to the US, investors will sell dollars, buy pounds, and invest in the UK. This will weaken the dollar and strengthen the pound. If if UK rates fall, then relative to the US, of course, investors will do the opposite. Will buy dollars and sell pounds and invest in the US. This will strengthen the dollar and weaken the pound. All right, does that make sense? Good, good, good. All right. So let's see. Hold on one second. I want to see what they have to say about so here they're showing us that when there's a change in interest rates, both supply and demand are being affected. So they're telling us here that if US rates go up, which is the same thing as saying UK rates go down. That would be the second case. Then you'll have this graph. Yeah, for some reason they don't use ones in their graph like I do. That's a little annoying, but there you go. So let's say that originally the equilibrium exchange rate was um, let's stick with the numbers we have here. Initially, remember, the exchange rate was $1.25. All right, so let's go with that one. So let's say in this case, they're telling us that if US rates rise, or equivalently, UK rates fall, the impact will be, now, this means that there's rates are higher in the US. So British investors will sell some of their pounds in order to invest in the US. They'll sell pounds and buy dollars to invest in the United States. So the supply of pounds will go up. But the demand for pounds will go down because Americans will be less likely to invest in the UK. And so we end up down here, let's say at $1.10. And that means the dollar gets stronger. The quantities aren't really that important. We're really focused on the prices, but all that really matters is that this amount goes up. Let's say from 1,000 to 1,200. That would be the second case. Now, for the first case, everything would just work in reverse. Okay. So I can kind of recycle this graph a little bit by changing keywords. Okay, fall and rise. The dollar depreciates. And the curves work in the opposite direction. Okay, so all right, so here's what it would look like. Instead of the supply of pounds going up, it goes down. And instead of the demand for pounds going down, it goes up. And let's say this brings us to $1.40. Okay. So those are two of the really most important factors that determine exchange rates, interest rate differentials and inflation differentials. But there's others. Okay. It's not the end of the story. Okay. For example, we have income levels. Now, when they say income levels, they mean GDP basically. So here we have interest rates, here we have inflation. So income, GDP affects a country's ability to buy foreign goods and services, as well as invest in foreign assets. Okay, so if GDP rises in the US relative to the UK, Americans will invest in, well, now Americans will invest in both more US and UK financial assets. They will also buy more goods and services in both countries. The UK will not be affected by this. In other words, the British will continue to hold the same number of pounds and dollars. So that indicates that in the US, the demand for pounds will go up with no change in the supply. Okay, notice because this does not affect the British, the ability of the British to buy our goods and services, the impact will be entirely felt on the demand curve. Oh, they don't have a separate graph for that. Oh, yes, they do. So you can see the American demand will go up with no change in the supply. Now, you notice something interesting here. Paradoxically enough, even though incomes are higher in the US, the dollar actually depreciates against the pound because we're eager to buy British goods now with our higher income. And so as a result of that, we do see a weaker dollar. Now, of course, it's the other way around. If your GDP rises in the UK relative to the US, the British will invest more financial assets. They'll buy more goods and services. US will not be affected. So the demand for supply of demand pounds will go up. Into the United States, that is, with no change in the demand. Okay, so the graph will just go the opposite direction. Okay, so, and again, although it sounds backwards, the result will be a stronger dollar, that is, and a weaker pound. Now, there's a couple of other factors they mentioned here. Government controls. All right, what is that all about? Okay. This mainly refers to tariffs and quotas on imported goods. Okay, so if, let's say, the US government imposes a tariff on British goods, Americans will, British goods will become more expensive in the United States. So that Americans will buy fewer of these goods. As a result, the demand for pounds falls. By the way, the same thing is true for quotas. So let me change this to opposes a tariff or a quota on British goods. British goods will ultimately become more expensive. Americans will buy fewer. The demand for pounds falls. Now, what happens based on our graph? So if the demand for British pounds is going down, and that means the dollar gets stronger and the pound weakens. Okay, so if the UK government imposes tariffs or quotas on the US goods and services, the opposite will occur. The supply of pounds will fall, and the dollar will get. So as the British find that American goods are more expensive, and they buy fewer of them. Okay, so this will weaken the dollar, and the pound strengthens. All right. There's one more, I believe. Expectations. Okay. All right. Now, the way this works is this. If Americans expect, so let me see how, let me make sure I'm following that what they want to do here. Oh, I see. Okay. Well, expectations can change in a lot of ways, but let's say Americans expect interest rates to rise in the UK. Before they even rise, Americans will buy more pounds to invest in the UK, and more pounds rises, and the dollar. Now, there could be other expectations too, like inflation changing it, whatever, but this is the one that's probably the most important because investors are basing their decisions on these expectations. So US demand for pounds goes up. And we end up here. So, okay. So that, in other words, with the higher demand for pounds, the dollar weakens and the pound strengthens. But if we expect the opposite, um, they will buy fewer British pounds, or they'll actually sell off some of their pounds, buy more dollars, and invest in the US. The demand for pounds falls, and the dollar will strengthen while the pound will weaken. So we're just shifting this demand curve to the left now. Okay. So I think that covers all the factors that, or at least the ones in this book. There could be others. So here they're showing you just sort of a summary of what all this is all about. So in other words, the trade related factors are inflation, income differentials, government trade restrictions. The financial factors would be interest rate differential, capital flow restrictions. We didn't mention that one. Sometimes governments put restrictions on how much foreigners can invest in a country. And then expectations affect supply and demand, and that will ultimately determine the equilibrium exchange rate between that country and the dollar. Okay, so it's 8:40. I actually forgot all about the break. So I'll tell you what, it's kind of late, but you're probably hungry or thirsty or something. Why don't we come back around 9-ish, 9:05 maybe, and then we'll wrap up this chapter. We got most of it done. There's a little bit left. We got the important stuff done. So let's do that. And then we'll wrap this up. And then next week it looks like we're going to start the derivatives, which is a very intense discussion. So let's do that. And so I'm going to pause the sharing so that The video doesn't have a lot of dead air in it. And we'll be back in a while, okay? Excellent. All right, I guess we can get back to it now. Um, so like I said, we're largely done with this chapter. There's a little bit more to do. And then next week, we're going to spend the entire chapter on derivatives. In fact, that one might take more than a week because it's fairly complicated. We've already briefly introduced currency derivatives one or two chapters ago. We did actually see some of the basic features, but now we want to dive more deeply into what exactly are currency derivatives and what are they used for. So that's going to take a while because they're very complicated products. But here we just want to remind ourselves that in addition to exchange rates, if there's an impact on, let's say, the dollar and the pound, that's also going to affect all the cross exchange rates that are defined with respect to the dollar. So they, for example, here what they've done is they've got the British pound and the Swiss franc, and you can see how individually they bounce around over time, and then the green line is the cross exchange rate between them, which means that that green line is being affected by both the British pound and the Swiss franc at the same time. So yeah, here they're showing numerically how they obtain these results. But the bottom line is they're just taking these numbers, calculating the exchange rate between them, and they come up with this green curve. So again, I mean, it stands to reason that as we see changes in the dollar, of course, it's going to affect cross exchange rates as well. So now here they're getting into more detail about how does how do companies take advantage of changes in exchange rates? So that's kind of an interesting idea. Institutional speculation based on expected currency appreciation. So in a way, this is no different than buying stocks. When do you buy a stock? Ideally, you want to buy a stock when you expect the price to go up. Same thing happens with currencies. If you expect the dollar to get stronger, for example, then you would want to buy it or sell another currency against it. So how would that work? All right, well, let's say an American corporation, and let's say it's an American multinational. Well, they have business interests in many different countries. Believes that the British pound will appreciate against the dollar in the future. Okay, so what do? So let's do some numbers. Let's say currently the spot exchange rate is $1.25 per pound. All right. Let's say, suppose the corporation thinks that in 1 year, this will be, let's say $1.15. Okay, so you want to hold, let us say that a corporation uses $100,000 to buy
So that's the price.
British pounds at the spot exchange rate of $1.25 per pound.
Oh, yeah.
It's March, right?
Yeah.
So I
Oh.
like.
Oh,
I don't know.
well, you're welcome.
No one was here.
Anyways.
Okay. All right, anyway, $1.25 per pound. So that means that the corporation ends up with how many pounds? Let's see. I hope I chose good numbers here. I would love it to work out to be an even amount. I wasn't that careful here. Let me just try this. So the number of pounds would be, I need my calculator. Oh, we're in luck. It's $80,000 exactly. Beautiful. All right. I always like even numbers. All right. So 1 year later, if the exchange rate does fall to $1.15 per pound, these pounds will be worth. Now when we multiply these together, you'll get it's 80,000. $92,000. So in other words, that proves to be a mistake because we end up losing $8,000. So if instead the corporation uses, let's say, 100,000 pounds to buy dollars, okay. These this equals so at $1.25 per pound, you multiply these together, and you'd end up with $125,000. 1 year later, the exchange rate does to 115. Wait, let me just double check. So in the first case, they used dollars to buy pounds. We end up with 80,000 pounds, which ultimately is worth 92,000. But instead, if we used bought dollars, um, all right, I see what we're doing. Okay. So the dollars will be worth now, in other words, these dollars that we acquired can be converted back to pounds. And so that ratio is 108, 695.65, which is a profit, of course, of $8,695.65. Okay. So in other words, we can speculate by either trading dollars for pounds or pounds for dollar. That depends on which currency we expect to get stronger. Now, of course, we make money only if we're right. Right. If the dollar depreciates instead, the corporation can lose money with its speculation strategy. So in other words, making money depends on taking the right position based on your expectations and also then being right. But of course, speculation is another word for gambling, and there's a reason for that. It is gambling. You don't know what's going to happen in the foreign exchange markets in 1 year. But what you can do is make sure that you're picking the right position, that you'll actually benefit if you're right. All right. So now the carry trade, you see this here. This is kind of, you don't see this so much anymore, is a situation where a multinational, let's say, attempts to save money or earn a speculative profit by converting converting the currency of a country with relatively high interest rates into the currency of a country with relatively low interest rates. So let me show you a quick example of this. Suppose that the US rate of interest is 3% and the Japanese interest rate is 0.5%. Okay. So a multinational. Oh, and we need to know the exchange rate. Suppose the exchange rate is 100 yen per pound, or per dollar rather. Here's the yen. Okay, so a US corporation um, borrows let's say 100 million yen at, of course, 5% and converts them into dollars. That's $1 million, by the way. Okay, the dollars are deposited in a US bank at a rate of 3%. Now, 1 year later, the dollars are worth $1,030,000. Okay, now here's the thing. The investor must repay the Japanese yen loan, which will cost him. So we actually borrowed 100 million yen. And we pay an interest rate of 5.5%, which is 0.005 plus one, the principal. So we're multiplying 100 million times 1.005. That's going to be 100,500,000 yen. Now, here's the question. How many yen do I have now? So the investor collects the $1,030,000 from his US bank account. And converts them back into yen. Now, suppose that the exchange rate hasn't changed. Then that means the dollars will be worth. So we multiply this by 100 yen per dollar. And that means we'll have 103 million yen. Okay. After repaying the loan, investor has. So we have 103 million yen. And then we subtract out the repayment of the loan. And that leaves us with 2.5 million yen. Which is worth, at the current exchange rate, this is worth $250,000. So this profit comes about because of the differential interest rates in the two countries. Now, here's the tricky part. Suppose that during this period, the yen appreciated during this period to 80 yen per dollar. What would have happened? Well, the investors' dollar balance of 1,030,000 would be worth. So now we're dividing by 80. Sorry, we're multiplying by 80. And instead of 103 million, and it would only be worth to multiply this out. And we get 82,400,000 yen. Okay. So after repaying the loan, balance of. Remember, it's 1,000,000, 100,000,000, 500,000 yen. The investor has a loss. Oh my God, they actually lost money. So let's see how much that is. 82 minus, let's see, 105,000,000. Now we're looking at negative 18 million. 100,000 yen, which is worth and remember the dollars 80 yen. Oh, this is divided by. So when you divide by 80, you get negative 226,000. 250. So you see, there's the thing with the carry trade. But oh, by the way, on the other hand, if the yen had depreciated, the investors' profits would have been even greater. So this is the key to the whole thing. With the yen, with the trade, the carry trade, the investor is hoping or is assuming that the foreign currency won't appreciate in the near future. So if you're really convinced of that, and if you can find a currency with a much lower interest rate, you're in business. Now, this trade was very popular in the 80s and 90s with the yen and the dollar. Because, dollar interest rates were much higher than in Japan. And here's the interesting part. The Central Bank of Japan had a policy of preventing the yen from appreciating, or at least too much, as this would have reduced its trade balance, its trade surplus, potentially at least increasing unemployment. So all the traders in the market knew that. The Japanese government, if they saw the yen getting stronger, that they would actually take steps to make it weaker. And so it seemed like no risk at all. And that was true for many years. Then things changed where Japanese interest rates, US rates fell to Japanese levels, and the Japanese government stopped preventing the yen from rising so much. But that's what the carry trade means. Yeah. So yeah, the risk of the carry trade is exchange rates move the opposite of what the investors expected. Exactly. Anyway, so here's our summary. And that seems to be about it. Now, this document I've been typing all night. It's quite long, as a matter of fact. I'm going to post this in Brightspace. And just like last week, I'm going to post the video on YouTube. So you can go watch it when it's ready. Now, it isn't ready automatically. It takes a while to process it, but later on tonight or tomorrow, you'll find it in my YouTube account. This I'm going to go post into Brightspace as soon as we're done. So if you missed anything, all the notes are right here. Okay, this is one of the great things about being online. I can just hear it. I mean, on the Blackboard, I can't save it, right? So this is one of the big advantages. And not only that, but you can't watch the video. So here it is. And so like I said, next week we'll start looking at currency derivatives. And that's a much more complex topic. So it might take a couple of weeks to get that one finished. But we'll do it. Okay. So I guess I'll see you all next week.
Bye. Have a nice night.
All right. You too. Bye.
Bye.
Goodbye.